Today, we're diving into something that's on the minds of many of us: investing during uncertain times. Whether it's a rocky economy, fluctuating stock markets, or global events causing volatility, a lot of people are feeling uneasy about where to put their money. Let's first take a quick look at the current landscape. Over the past few years, we've seen some major shifts in the global economy. Rising inflation, interest rates on the rise, and of course, the unpredictable nature of world events. All of this creates a lot of uncertainty, which can lead to volatility in the stock market and other investment sectors. So it is understandable if you're feeling a bit nervous about where to invest your hard-earned money. But here's the thing, uncertainty is nothing new. The markets go through cycles of boom and bust. What matters is how you react to it, and more importantly, how you position yourself for the long term. One of the most important principles of investing, especially in uncertain times, is diversification. And I can't stress this enough. Diversification simply means spreading your investments across a range of different asset classes. So, if one area takes a hit, your entire portfolio doesn't fall apart. For example, you might invest in a mix of Canadian and international stocks, bonds, real estate, and even commodities like gold. While the stock market may be volatile, other areas like bonds or real estate might be more stable. By having a diversified portfolio, you reduce risk and increase the potential for returns, no matter what the economy is doing. Now, I know it's easy to get caught up in the short-term noise. Markets fluctuate, headlines scream crisis, and it can feel like you need to make big moves. But if you're investing for the long haul, the day-to-day ups and downs are just background noise. Historically, the markets tend to recover from downturns, and long-term investors who stay the course often see good returns. A great example of this is the Canadian stock market. If you look at the S&P/TSX Composite Index over the last 20 years, despite some major dips, it's still trending upward. So keep your eyes on the long-term goals, whether that's retirement, buying a house, or building wealth. And don't get too distracted by short-term volatility. In uncertain times, it's crucial to focus on quality. While it's tempting to try and pick the next hot stock or jump on a trending investment, the truth is, quality companies tend to weather downturns better. These are companies with strong balance sheets, solid business models, and consistent earnings growth. Even in rough patches, these companies are often able to adapt, innovate, and maintain their profitability. If you're worried about market fluctuations, sticking to blue-chip stocks can provide some peace of mind. Another key tip is to keep some cash on hand. It might seem counterintuitive in a world where everyone's telling you to invest everything you have, but having some cash reserves can be a great strategy during uncertain times. Not only does it give you a buffer against market dips, but it also allows you to take advantage of opportunities if the market dips significantly. This doesn't mean holding on to large amounts of cash indefinitely, but having about 3 to 6 months worth of expenses in an emergency fund is a smart move. That way, you're not forced to sell investments in a downturn just to cover your living expenses. As Canadians, we have access to some great tax-advantaged accounts that can help you grow your wealth more efficiently. If you're not taking full advantage of your RRSP and TFSA, you're leaving money on the table. For example, contributions to your RSP are tax-deductible, which can lower your taxable income in the short term, and any growth within the account is tax-deferred. Meanwhile, a TFSA lets you earn tax-free growth on your investments, so all of the gains you make with a TFSA, whether it's from stocks, bonds, or other investments, are yours to keep. By utilizing these accounts properly, you can maximize your returns over time and minimize the impact of taxes. This brings me to a very important point. Avoid making emotional decisions. It's tempting to panic when the market drops or get greedy when everything seems to be going up. But acting on fear or excitement rarely leads to a good outcome. A steady, disciplined approach is key to long-term success. Remember, the most successful investors are those who stick to their plan, even when it feels like the world is falling apart. If you're feeling anxious, take a step back, breathe, and focus on your goals. Investing is a marathon, not a sprint. So, to recap, in uncertain times, focus on diversification. Think long-term. Prioritize quality investments. Keep cash reserves. Take advantage of tax-efficient accounts and avoid making emotional decisions. The market may be unpredictable, but with the right strategies, you can navigate it with confidence. I hope this video helped you feel a little more secure about your investment strategy. If you found it helpful, make sure to hit the like button, subscribe to the channel, and leave me a comment with any questions or thoughts you might have about investing in uncertain times. Thanks for watching, and I'll see you in the next video.